And people often ask about, like, they get fractional reserve lending round the wrong way a lot of the time. And it's an interesting concept because you'll say, how do you think fractional reserve lending works? And it's the fractional reserve lending or credit creation is the bit that people get stuck with. So it's like the same 100 people on the same island with the same bank, and each have £10 and they've all put it in the bank. So there's £1,000 in total in the bank. And how the credit creation license works is the bank creates new money. So when the person that wants to build a shack asks to borrow £100, it isn't £100 that comes out of the money that's been given to the bank. The bank actually creates a new £100 through this banking license where they can take that £100 and lend it to the person that's wanting to build the shack. So instead of the total money supply being £1,000, it's actually now £1,100. So you go, well, okay, right. So the money is created. But what you've went on to say there is that, well, it's a powerful tool if you can create that money, and what you give that out, what purpose you give that lending for can distort an economy. Meaning that if you give these out for really productive reasons, then it's great because you have productivity. People can prosper. There's growth. People can get employed. But if you give that lending out for speculation or speculative purposes, what happens then is it distorts the economy and prices within the market.
Yeah. So a couple of things just to clarify. So the first thing is for people who've heard of fractional reserve banking, and many people have, and they sort of get their heads around that. Fractional reserve banking is not credit creation in terms of it's a different theory of banking, and it's actually been proven wrong. Fractional reserve theory is all around the reserve requirement at the central bank. And the Federal Reserve came out many years ago and also admitted it. They put in one of the very bottom of one of their press releases, it was very hidden. They basically said, we're abolishing reserve requirement because we realize it has no impact. So they just did it very bottom of one of their press releases. In 2014, you don't have to take my word for credit creation. In 2014, the Bank of England came out and admitted as well in their official statements that banks issue deposits and they create money out of thin air. So the central bank admits it as well. But what you're saying is right. So you've got this £1,000 in the system. You've created another £100. Now, that £100, if it was used for productive purposes, then ultimately the business that's borrowed it has used it productively, which means they can repay that £100. Everyone's happy because there's been growth, there's been productivity, and the money's then repaid in the long term. And of course, when money's being repaid, more money's being created as well. So it's a never-ending, game of money creation and money repayment. On the unproductive side, wherever you're creating this money, you're effectively inflating that part of the economy. So you've got GDP transactions, which are transactions that result in nominal GDP growth. So that can be consumption. It can be investment, for example, if it's consumption, that's not negatively a good thing. So in 2020 to 2022, when consumption boomed and credit was being created for that element of GDP, we saw nominal GDP rise. Fantastic. Everyone thinks that's great because you've got growth. But actually, real growth was low because that was all down to the inflation of the consumer prices going up because you're pumping money for consumption. So prices are going to go up as more people are buying goods, but there's less goods being created. But you've got something even worse than that. You've got something outside of GDP, as you said, like asset price speculation, which is, let's say I'm going to the bank and I'm saying, I want you to create credit for me to gamble on the asset markets and to buy assets, effectively. Just buy assets which don't contribute to GDP. So let's say I want to buy real estate, and that's it. And I'm going to gamble that the value of my real estate is going to go up, and then I'm going to sell it. Okay, the bank's creating money for that purpose. What happens is that industry starts to get inflated. It's like a balloon being inflated with air. That money is being put in there, which inflates the whole system. So prices are going up. Everyone's happy. The banks are happy because of the value of the collateral, which is the real estate that has been purchased, is going up as well. So the banks are protected. The loan is over collateralized at this point, and the borrowers are happy because suddenly they're getting a return. So what happens? More people borrow for this purpose, and the banks give out more loans for this purpose. They create more credit to go into this industry, which inflates it even more, and it goes up and up and up. Now, this is great until the music stops playing, until the banks stop creating credit for that purpose. And as soon as that happens, everyone realizes the prices are way overpriced. The assets are way overpriced. Suddenly, the collateral that's being posted by the borrowers is worth nothing, and the borrowers can't repay the loans because suddenly the value of their investments has fallen, which means banks are then left with this awful portfolio, this awful loan book, which isn't going to be paid. So it's called non-performing loans. And banks only have a very small margin of error because they have the capital, the actual bank capital, tier one capital is their sort of, if you like, that's their buffer of if everything goes wrong, how much of a mistake can we make before we declare bankruptcy? That we have no capital left to cover our losses. And it's only very small. You're looking at, there's various buffers attached due to Basel requirements, but you're looking at the first minimum amount is 8%. And then everything goes added on to that. But let's say 8%. Even if we say 15% is if banks have 15% of their tier one capital, it's still nothing. That means if you've got 15% of your loan book has all defaulted and they're not and there's also, it's all losses and they're not repaying it and the banks aren't getting the money back, the bank's done. So it's a very small margin for error, which as soon as you realize all that, you realize, okay, the purpose of the loans that are being given out, that has a huge impact on the macroeconomic space. Maybe we should focus more on helping those small businesses which are productive and can repay the loans.
Yeah. Why would you not just get when you said there, the Federal Reserve put at the bottom of their statement that capital requirements aren't really
not capital requirements, reserve requirements. So that's the amount of reserve that banks have to post at the central bank. And they said it doesn't make a difference to the amount of credit that is being created by the banks. That's effectively what they were saying. It doesn't impact. And that's because the theory of reserve requirements is based on the fractional reserve theory of banking, which is incorrect. Banks can create money regardless of what the reserve requirement is at the central bank, pretty much.
Yeah.